Welcome to HouseLux Estate, your go-to channel for all things business and finance. Here at HouseLux Estate, we believe in the power of knowledge, particularly when it comes to understanding the complexities of the business world. Our mission is to simplify these intricate concepts, providing you with a clear and comprehensive understanding of the financial landscape. We're here to shed light on the fascinating intersections of business, finance, and governance, making it accessible and engaging for everyone. Whether you're a seasoned business professional, a budding entrepreneur, or a curious student, there's something here for you. Today we're delving into a topic that doesn't always get the attention it deserves, but plays a crucial role in the business world: corporate governance. We'll be examining its influence on financial decisions, exploring case studies, and discussing why it's so vital in today's corporate landscape. In today's video, we'll explore how corporate governance impacts financial decisions. But first, what is corporate governance? Corporate governance is the framework of rules, practices, and processes by which a company is directed and controlled. It's like the compass that guides a ship, ensuring it stays on course, avoiding the rocks of mismanagement and the whirlpools of financial scandal. Corporate governance involves balancing the interests of a company's many stakeholders, such as shareholders, management, customers, suppliers, financiers, government, and the community. It's a delicate balancing act that requires a keen understanding of the business world and a commitment to ethical conduct. At the heart of corporate governance are the principles of transparency, accountability, fairness, and responsibility. Let's break these down. Transparency refers to the clear, accurate, and timely disclosure of information to stakeholders. It's about shining a light on the company's operations, making sure nothing is hidden in the shadows. Accountability, on the other hand, is about being answerable for one's actions. It's about stepping up and accepting responsibility when things go wrong, not passing the buck or playing the blame game. Fairness is about treating all stakeholders with equal respect and consideration. It's about ensuring that everyone has a voice and that their concerns are heard and addressed. Responsibility is about acting in the best interests of the company and its stakeholders. It's about making decisions that are ethical, legal, and sustainable, not just profitable. These principles form the bedrock of corporate governance, guiding the actions of the board of directors, the management team, and all employees. They shape the culture of the company, influencing everything from strategic planning to day-to-day operations. However, corporate governance is not a one-size-fits-all solution. It varies from company to company, depending on factors such as size, industry, and geographic location. Yet regardless of these variations, the underlying principles remain the same. Now that we understand what corporate governance is, we can delve into how it impacts financial decisions. Let's take a step back in time and examine the Enron scandal. Enron, once the seventh largest company in the United States, serves as an infamous case study on the catastrophic consequences of poor corporate governance. It was the year 2001 when Enron filed for bankruptcy, shocking the world and shaking the foundations of corporate America. The story of Enron is a tale of greed, ambition, and a stunning lack of corporate governance. Enron was known for its pioneering efforts in the energy sector, but beneath the surface, the company was riddled with deceit and corruption. The senior executives, with their unchecked power, made a series of financial decisions that ultimately led to the company's downfall. The company's board, which should have been the watchdog, was instead a cheerleader, approving risky financial decisions without due diligence. The board's passivity and lack of oversight allowed the executives to manipulate financial statements, hide debts, and inflate profits. The auditors, who were supposed to be the guardians of truth, turned a blind eye, further contributing to the financial misrepresentation. This lack of accountability and transparency created a corporate culture that prioritized profits over ethics. When the truth came out, it was too late. Enron's stock, which had once peaked at $90 a share, plummeted to less than $1. Thousands lost their jobs, and investors lost billions. This scandal spurred significant changes in corporate governance regulations, including the Sarbanes-Oxley Act, which was designed to increase transparency and hold executives accountable. But the Enron scandal is more than a history lesson. It's a stark reminder of the impact of corporate governance on financial decisions. It underscores the importance of checks and balances, the necessity of transparency, and the consequences of unchecked power. As we can see, poor corporate governance can lead to disastrous financial decisions. Enron's story is a cautionary tale, a warning to all organizations about the dangers of ignoring corporate governance. It's a lesson we must never forget. Fast forward to the more recent Volkswagen emission scandal. This case takes us across the Atlantic to the heart of Germany's automotive industry. The Volkswagen emission scandal, also known as Dieselgate, erupted in 2015 when Volkswagen was found to have installed secret software in their diesel cars. This deceptive software allowed the cars to pass emission tests, while in reality, they were emitting up to 40 times the permissible limit of nitrogen oxides, harmful pollutants linked to respiratory diseases. The consequences: a global uproar, significant reputational damage, and financial losses amounting to over $30 billion in fines, settlements, and remediation costs. But how did corporate governance, or rather the lack of it, play into this scandal? Volkswagen's governance structure was arguably riddled with flaws. The company's supervisory board, tasked with overseeing the management board, was heavily dominated by the Porsche Peach family, Volkswagen's largest shareholder. This concentration of power hindered the robust oversight necessary in a well-governed corporation. Furthermore, the company's dual board system and its complex web of shareholder interests created a breeding ground for a lack of transparency and accountability. The scandal could arguably have been prevented if Volkswagen had adhered to principles of good corporate governance, such as transparency, accountability, and fair representation of all stakeholders. The Volkswagen scandal also exposed the financial implications of poor corporate governance. Beyond the immediate financial hit from fines and settlements, the company faced a long-term impact on its share price and market value. Investors lost confidence, and the company's reputation took a nosedive. This case proves how good corporate governance can help companies make better financial decisions. It emphasizes the importance of a robust governance structure in fostering a culture of accountability and transparency, which in turn can help prevent such costly scandals. It's a stark reminder that short-term financial gains achieved through unethical practices are not worth the long-term financial and reputational damage that can ensue. In the end, good corporate governance isn't just a nice-to-have. It's a must-have for the financial sustainability of corporations. This case proves how good corporate governance can help companies make better financial decisions. So why is corporate governance so important? Well, let's dive in. Corporate governance is like the backbone of any organization. It's the system of rules, practices, and processes by which a company is directed and controlled. But what does that mean for financial decisions? In essence, good corporate governance is the guardrail that keeps companies on the straight and narrow. It ensures that decisions are made with integrity and transparency. This creates a culture of accountability and trust, which is essential for any business to thrive. Let's think back to our case studies. Enron, Volkswagen, these were companies that made poor financial decisions, not just because they lacked appropriate oversight, but because their corporate governance was fundamentally flawed. They allowed for a culture where the pursuit of profit overshadowed ethical decision-making and transparency. In contrast, a company with robust corporate governance will have mechanisms in place to prevent such disasters. It will have a clear separation of powers, checks and balances, and a commitment to transparency and accountability. It will make decisions that are in the best interest of all stakeholders, not just the top executives or shareholders. Moreover, good corporate governance doesn't just prevent scandals, it also promotes financial health. It ensures that resources are used efficiently, risks are managed effectively, and that the company can adapt to changes in the market or regulatory environment. This, in turn, leads to improved financial performance and increased investor confidence. In a nutshell, corporate governance is the compass that guides a company's financial decisions. It's what keeps the ship steady in stormy waters and ensures it stays on course towards its destination. Without it, companies risk losing their way, making poor decisions, and ultimately, sinking. And let's not forget, corporate governance isn't just the responsibility of the board or the executives, it's everyone's responsibility. From the employees to the shareholders, we all have a role to play in ensuring good corporate governance. As we've seen, the impact of corporate governance on financial decisions is immense. It's not just a buzzword or a box to be ticked. It's a fundamental aspect of any successful business, and one that should never be overlooked. That wraps up our discussion on corporate governance and its impact on financial decisions. We've traversed the labyrinth of corporate governance, diving deep into its core, understanding its pivotal role in steering the financial decisions of a company. From the Enron scandal to the Volkswagen emission debacle, we've seen how a lack of stringent governance can lead to financial catastrophes and irreparable reputational damage. In essence, corporate governance is not just a set of rules. It's the backbone of a corporation, ensuring transparency, accountability, and fairness. It impacts a company's financial decisions at every level, shaping the organization's course towards growth and sustainability. So, remember, a sound corporate governance structure is not an option, it's a necessity. It's the beacon that guides financial decisions towards the betterment of all stakeholders, steering clear of scandals and fostering trust. Thank you for watching. If you enjoyed this video and found it informative, please subscribe to House Lux Estate for more insights about business and finance.